Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for the Thursday edition of Trader Talk in today's market. I am your host, Kevin Horner. Pleased to be joined today in the chat, that is, by my friend, fellow Schwabby, Mr. Scott Thompson there, everybody. Please say hey to Scott this morning. We don't get Scott nearly enough here in the chat, so make sure y'all keep him busy today. Of course, the market's been giving us plenty to stay busy the last few days here, needless to say. So we're going to talk about some interesting levels, of course, looking at a lot of intra-period charts to discern whether we can take any knowledge from what's gone on of late, find some areas of short-term support and resistance that might offer some insight as to the potential next move. Of course, ultimately, we'll be leaning into how we manage anything we're thinking about there as opposed to predicting what's coming in the future, but we will use some technical analysis as we do all of that. So if you're not already doing so, please take a second, follow Scott and me on X. We're available there with our names, Kevin Horner CS, Scott Thompson CS. Great spot to find us. Of course, this class is being recorded and will be archived shortly after completion. You can always rely on the channel here to find older or archived segments. All right, so with that, let me get to disclosures before we move to the charts. Please remember that everything we cover today should be considered informational and educational only. We do not make any recommendations here nor any endorsement for a specific approach to trading. What we will do is bring to light some concepts and strategies of technical analysis that traders might choose to incorporate. In doing that, though, remember that technical analysis is just one of our decision-making puzzle pieces, and we discourage you from making decisions exclusively from technical analysis. And for really, we think that it makes sense to consider a multitude of factors as you're building out your process and your planning for your individual trades. Now, as an agenda, we start with a top-down approach here. That means simply we start with our major indices. So we're going to look at the S&P 500, the NASDAQ 100, the Russell 2000. We'll look at the semiconductor index, expand today as well. Some interesting charts in materials space as the conversation maybe around precious metals, for example, has shifted. We'll talk a little bit about that, and we'll move into stocks in the news as we often do on this particular Thursday solo session. So please, any questions you guys want to bring to light, do not hesitate to do so. I can see already that the Thinkorswim Starburst shirt catching some comments in the chat, and I always appreciate that. I love wearing this shirt. One, it is a conversation starter, but two, I just love it. It's very much who I am. I love a good button down, nice, comfortable and lightweight as this one is. So thanks everybody. Now let's take a look at that S&P 500 here. We fell to that area of short run support here, everybody. The gap ledge created on May 6th, and we have been dabbling at it. We're really discerning right now whether the 50-day moving average is going to hold up for us and provide us any short run support. And you can see we've made date, at least this early session, 3 higher lows along the way. So some of us are going to take that as a little bit of a positive. Let us move in, however, to the hourly bars. And we're going to take a peek here over what is the last 90 days. And there's that line, that same horizontal support I was talking about that you can see we're testing as we speak. Now, from a trend standpoint, the short-term trend working against this 100-hour moving average is no longer providing support and thus now can be providing us with some resistance. So the question is whether we even have a shot to rally into that 100-period moving average. Chances are we're going to need to take out some of these shorter, faster moving averages first. So let's see which of these might be offering resistance closer than the 100-hour. How about the 50? Okay, the 50 is a little bit higher, or a little lower, closer to us in terms of price action, but not quite what we're looking for. What about the 20? Now there we go. So there you can see we have at least a level above which we need to get an hourly candle to maintain. That level is 73.45, about 60 points away from where we are right now. And we're going to need at least 1 hour bar that takes you through it and holds. Look at how we got up there early morning a couple of days ago, about a week ago as it was, I guess. This was, 2 days ago, pardon me. got above it, and then immediately right back below it. So this is what we're looking for. Remember, everything we discuss on those hourly charts or weekly charts, it can all be applied to your intra-period charts as well. Remember, technical analysis, fractal in nature, it means everything that we do from a trend standpoint and understanding of support and resistance, etc., it all can be applied to these shorter term charts. And the big takeaway here is, what are we looking at? Lower highs, right? Lower high, right here. And then, if we take out support, obviously we have risk for going lower, right? So the one positive we could take away is that the bounces here have been a little bit better. We've been finishing a little stronger on the end of these candles. So we've got an improving RSI, even though price hasn't quite moved for us yet. But unfortunately, that is not necessarily something we can infer price action from. So let's make sure we stay disciplined to our process. And the process largely will keep some of us a little bit on our toes. And so I'll remind you, while our drawdown here in terms of price movement from the peak is fairly limited, and I do mean small, because look, if we take just our peak to trough move at the 50-day, I think we're looking at about a 5.5% drawdown here. Let me just check it out. 5% from that peak to the trough. Here it's 8 bars if we incorporate today. So a very short pullback that should be considered to be standard relative to most of these trends. So let's see if we can grab some support here around the 50-day, but ultimately that's the first level we need to see hold here. Now that we've taken out the 10-day and the 20-day with some conviction, the 50-day could be the spot for us. So we're going to monitor that here in the SPX. Let's see how our NASDAQ 100 is doing. Fairly similar in scope. 50-day is catching up quickly with our price action, and we can see that we tested the gap level up here. I'm going to snap that one and just slide it up a little higher. So you've got a couple of them right there, and maybe even a zone of support if we were to break down, right? So as always, and I know, again, we don't always want to think about those lower levels, everybody, but I'm a believer that it is super important along the way to set levels you think can be support and then say, all right, what if I'm wrong? Where is the next level of potential support? What should I be prepared to see if the selling gains steam? Where can I look to make another decision? Either that selling was so aggressive that becomes an area where I want to be a buyer, or selling down to this level was so aggressive that I need to tighten my own purse strings. I need to be moving out of some of those positions, building some cash, etc. That becomes a plan for us. But if we are simply relying on the immediate level of support that we define, I feel like that leaves us open to poor decision making and hastiness. And that's what we're trying to mitigate. We don't want hasty decisions. We want well considered decisions based on price levels that have been achieved. Remember, if we're technical traders working with price, well, then price should help us to dictate our risk management process. And so trading through an area of support, especially if it happens speedily or by a percentage move below the level that you've deemed to be support, well, then that should mean something for you in terms of action steps, right? What are those steps? Are you going to sell a portion? Are you going to sell a specific percentage? Are you going to use that as a reason to be a buyer? One or the other. Have a plan and know how you're going to want to address it. So 50-day does reside beneath us a little bit. We're at 28.6, and so we're about 800 points above the 50-day. On the hourly chart, a lot of the same stuff here. There's that 20 period still providing resistance, and again, the same window there. Tuesday, we got above it, and then immediately back below it. That's why we're staying relatively defensive in here, because we like the green open, but we recognize that we've not done anything to change the short-term trend just yet. And that's what we're waiting on, right? So patience in the move and an understanding that the selling can possibly last as long as the buying did, right? You know, the buying move was 8 to 10 weeks or so before things got a little tired. We could possibly see that, or we could see us just get to the levels that are of import for the market, and we could get there quicker, which is why, again, I think it's so important to remember that price matters as much, if not more, than anything else. So maybe the speed with which we get there is difficult to sustain, but getting to those price levels and seeing action at those price levels can be very, very helpful for us. Let's see. Okay, this is a really good question. As I'm going to move over to the Russell 2000, but Nathan's question is, do you guys have any advice for not liking too many stocks and succumbing to analysis paralysis? It's a good question. I think one of the takeaways that some traders will incorporate is a look at very short-term moving averages and remind ourselves of what they generally mean. So utilizing the 20 period moving average, for example, in the window when the S&P 500 is rallying and using the 20 period moving average, what you're often going to find is S&P 500 stocks, obviously, specifically, those in that index, continuing to do well. And that means that, you know, breakouts can run, and pullbacks to areas of support in the stocks in that space can find support, hold support, and continue their trends. But when you break down under the 20-day moving average, commonly what occurs is a need to get that upward energy taken out of the index, and thus moves to the upside in S&P 500 stocks when we're under the 20-day tend not to necessarily stick, and they don't stick as well as the breakouts do when we're in rally mode. So be cognizant of the relationship between the broad index and the individual stocks within it that can let us know, hey, if I'm a trader and I get a breakout, I might, and the broad index is struggling, okay, but my stock is doing well. Recognize that in those imbalanced scenarios, it might make more sense to be a defensive seller into strength. Just as an example, when we go through these difficult windows, I say difficult, really standard pullbacks, right? We need to be recognizing that the sentiment of the market in that very short-term window is changing sufficiently to impact the way that our trades can hold. So with that in mind, when the market is breathing as we are right now, then maybe it makes sense to take breakouts for profit as quickly as we can, and pullbacks be a bit more defensive when they come to play. So if you step into pullbacks, you don't have to go full position sizes. And so ultimately, while I'm not telling you this is the way to approach it, but be thoughtful about what you're seeing from the major index with regard to the stocks that reside in it. And are you going to use that broad market weakness to suggest smaller position sizes initially, forcing the price action to dictate when you should be comfortable taking on those full positions once more? Chances are that'll start to show itself in the form of price action when we find the true bottom, right? When the bottom comes in and we trade outside of the pullback range that we've been looking at, for example, that 20-hour moving average, right? Once we get that challenged and through, well, then chances are we're in shift mode at that point, right? And that can be a little bit instructive. So, you know, give some thought to that. I think that can be kind of helpful for you. Trade and Grow, your question here, what the pullback could last 6 to 8 weeks. It's possible, but I think it's more likely that our pullbacks are not in scope with our rallies. I think it's much more likely that we pull back to an area that the market wanted to see in the first place. Hopefully it's the 50-day moving average. And I think price will dictate that. So I would say that our rallies can be expected to consider a 4 to 6 week, maybe an 8 week window, whereas our drawdowns are probably more in the level of 2 weeks to 4 weeks, a little speedier. And that's just anecdotal in nature because it's something I've kind of seen but haven't put to the true test. But if you just look at the way our rallies go, and the speed that our selling occurs due to whether it's algorithmic trading or anything else for that matter, it seems like price is what matters most. So the sooner we get to an area of support, the sooner we can get the bounce implemented, even if that area of support is reached in a 2-day, 3-day window. So, all right, let's look at our small caps here. Small caps are still holding on well. We're back below the 20-day with today's open and yesterday's close. You can see a lot of tails up in this space as we've had some volatility here. I mean, the tail we had on Tuesday was pretty significant, 29.20 all the way down to 27.90 essentially. We've basically had a humongous range that day. That candle looked great in the morning, and then, of course, at the close, not nearly as great. So we're doing okay here, holding up better perhaps than what we've seen in the S&P and what we've seen in the NASDAQ 100. Let's look at yields. So we are up 1%. Yields are pulling back. So we're seeing some buying of U.S. Treasuries, at least in the 10-year note. So far, so good in terms of that 455 area holding as resistance. So we filled into that. And now we've seen 4 days in a row with our highs at that level, and we're working to trade lower. So, a push down again below 4.5 would be nice to see. We'll see if that actually plays out. But that's kind of what we're looking for right here at this moment on yields, because that'll give us that headwind, or pardon me, the tailwind for the Russell that we've would like to see. And of course, again, I think that the Russell's been a little bit more resilient than maybe expected given the nature of the move here. Because you look at the move, I mean, from March, yields have rallied 55 and 56 basis points up there. That's pretty significant, right? In a speedy window. And if we looked at the Russell in that same period, just basically from end of February here, oddly enough, the end of February right here. So we had the Russell at around 2,600, and here we are 270 points above it in the face of those rising yields. And so I, as a trader, am trying to figure it all out, because I'm wondering, does that mean that expectation is for yields to go down, even though the evidence says otherwise? Yesterday, some of you, if you were with us yesterday, you saw Brent and I looking at the CME Fed tool, that third-party webpage that details how traders are positioning for expectations of rate cuts, and we see that cuts are more or less off the table, so much so that it looks almost like we're at risk of getting hikes, obviously, heading into the end of the year. We actually have a potential for rate hikes between now and December in lieu of cuts. So not just holding steady, but the potential to see elevated rates per the Fed. So plenty to keep an eye on as it relates to yields and rates, and expectation for rates can absolutely have an impact on what we're getting in the Russell. Of course, from a sector relationship basis, that means you're going to see those kind of impacts relative to utilities and relative to real estate. All right, let's look at our semiconductors here. Okay, now this is starting a little bit of a development, perhaps. We do have a little bias here. It looks better. It looks like we've actually got a little bit of a bounce underway as we speak. So we don't mind what we're seeing here, right, everybody? We've got the pullback to the 20, below it on Tuesday, but closed above it. Okay, so a significant tail. Yesterday, we got beaten back from that level and then closed below the 20-day. So a day below it does not a trend break necessarily. So we're watching that. And what about the hour-long bars? So let's take a peek here. Okay, a little bit of improvement. So we came down into our zone of support. We're moving off of it. We're going to hope to see that continues, but basically 1 hour above will not necessarily break the trend. And the truth is, even if we break the trend, we've got to find a way to make a higher high. So very short-term stuff here, everybody, but let us keep an eye on the gap zone up here. This will be an important spot, because any rallies that lead to that come to this space but don't hold is going to be a matching high, not a higher high. And a matching high means we can continue the lower trajectory, or at least the move we've been participating in, right? The first thing we need to break the short-term downtrend of the last week is a higher high, and we have not had a higher high yet. So this zone above could mean a rally spot. I mean, look at that. That's 12.7 to about, what, 13 and change, 13.2. So you've got a 200-point zone above us that could work out as, as a target zone for short-term bullish semiconductor traders here. That could work. Still too early to know for a lot of us, though, right? But I wanted to make sure we got a look at that on the intra period so that we could talk about some important levels. There you go. Kind of presents now this area up here kind of looks like it's on an island of its own, doesn't it? This 3-day topping formation. That's the other thing that stands out to me on the daily chart. Not a true breakaway or island because there's some wiggle room in between the gaps, and yet it still presents kind of like that, right? Big gap up, higher high, and then a gap back into the former zone of support. So this is a fairly important level above us. Getting back above it would be fairly significant for the semis. Thank you, Scott. I see we've got that survey opportunity in the chat. Scott will repost that for us a couple of times. But if you all just click that link, it's going to open in a browser window right next to this one, and then you can get to it post-show. Your thoughts are always appreciated. I love hearing from all of you. All of the comments you make, they come to me directly. One of the details that we've added to this class on Thursdays is to incorporate a trade process for discussion purposes. We do have an example trade in this class that we'll review at the end of today's class. So if there's anything you want to see me doing differently on a Thursday class specifically, let me know. Or if you'd like to offer your insights relative to Trader Talk broadly, I'd happily take those as well. Okay, let us look at a few of the futures symbols. Now I'm going to use futures symbols to evaluate price levels and price action, but we're not advocating for futures trading in any way. And remember, futures trading involves risk that it means it's not appropriate for all of us as traders. But the thing we want to look at, I want to look at metals, I want to look at oil, we'll look at Bitcoin. So collectively looking at some futures symbols here. Let's lead with oil. Now, the story here, we did hear from the administration that things aren't as swimmingly good in the conflict as we had been led to believe over the last few weeks here, and yet oil isn't really moving. Now, oil has spiked recently. You know, we've gotten into the 92, 93 zone, and yet we keep getting pushed back. And if we look at this on that same window of time, look, I mean, we can simply evaluate things the exact same way, but just on a shorter term basis. So here, oil appears to be kind of rangy, doesn't it? I mean, let's take this line and put it down below, and we can see that we've basically been in a range from about, let's call it 87 to 96. So about a $9 range now, going back to, what is this, May 22nd. So, hey, you're looking at about 3 weeks in length, and we've gone kind of sideways. And so for a lot of traders now, everyone, you could maybe just take the view that a trade through 96 on oil becomes bullish to the upside and runs the risk of rallying another 10 points a barrel, whereas the trade under 86 is going to be potentially beneficial, obviously, right? So significant opportunity here in oil if we can get outside of the range. But in the meantime, there's not a lot of directionality we can take from the oil chart. How about gold? Gold and silver have been on the slide. The gold move here, taking out the 200. We've been below the 50 and the 20 for much of this pullback, but it was this week's move that is most notable. And I think a lot of traders got more defensive late last week and maybe early this week specifically with our continuation. So we're looking at today would be, okay, so Friday, if I'm not mistaken, day 1, day 2, day 3, day 4, today, day 5 below the 200-day moving average. Have we reached a confirmation point that some traders are going to use to move on from gold positions? Possibly. Now, if you're trying to be as disciplined as you can, maybe the short-term bear looks at this and says, well, I think I can get a rally into former support, now potential resistance, and that would feel a little better to take some off as we rally back into the 200-day. That's a spot where some traders would look to do that and potentially take those profits. But I say profits assuming that they were a buyer way back when, because if you were one of those unfortunate buyers of gold back here over 5,000, it's certainly not been a healthy or a comfortable unwind, as we've given back, more than 20% from our peak, obviously. So, potential breakdown here in gold, something similar in silver. You're a little less aggressive to the downside, possibly finding horizontal support, just like we talked in gold, but day 3 below the 200-day moving average there. Now, one we don't always get to, but I wanted to check on today because it is so instructive as it relates to the economy, is copper. Now, copper shares here, or copper futures, I should say. The reason it stands out to me today is because of everything I've drawn in here. Had this short-term cup and handle. The handle got broke to the upside, and what did we do? We rallied into an excellent spot here, nice and strong, up to about 670. Then, from a technical analysis standpoint, we got largely what we thought we could get, the throwback to an area of support. In this case, horizontal support, the former highs, now current support. So former resistance, now support. Now we're at the 50-day, tested the 50. We haven't made that official move, right? We don't have a close above the high of the low day. Well, today could be the low day in our pullback, and we would need to see, do we close above the high tomorrow if that were the case. But it's an instructive chart, and it's a little bit helpful for us because breakouts in something like copper can tell us a little bit about the health of the economy, and it's kind of a balanced against all the negative narrative that many of you are listening to and hearing on your socials or your favorite news networks. As we digest all of this that's happening, it's really easy to be bearish in the midst of pullbacks, and yet when you look at something like copper, the indication here may be a continuation of the build out we've been talking about for better part of the last couple of years here. So copper still remains a very healthy need for the broader U.S. economy, and as we continue the AI build out also will be an important need as well. So the fact is, currently holding up, a move under the 50-day moving average could be significant. What about the risk factors associated with the Bitcoin move? Well, the Bitcoin move is interesting because we've been always talking about Bitcoin from a standpoint of a risk on, risk off appetite, right? And the market has been risk off with Bitcoin, at least for the better part of the last 3+ weeks. You can see we've pushed quite lower from 81,000 down to that 60,000 ledge. Now, a lot of traders are looking at this as clear support. Now, we don't have to get cute here, everybody. We can simply rely on the range. And yes, some traders are going to be willing buyers in the area of support because it reminds them that moves to the downside can lead to the potential for a range move equal to that of which we've been in. So this is a 20 to 21,000 point range. And so the thought here is potentially that you have, if it breaks, maybe you could visit the $40,000 area, right? Because the height of this range is 20,000. If it broke down, you might go another 20,000 beneath it, just equal to the range that we would be breaking. Of course, that's not to say it has to break. I think a lot of bullish traders are going to point to the fact that it has literally held this low, and lows have been well established for now 5 days. So if we look at that on the hourly, you can see starting to improve here, right? Little limited improvement often is the case. We get little baby steps of improvement on your intra-period charts that lead to bigger improvement over the longer window. So we're not going to be negative necessarily, but we do need to keep a close eye on what's happening here. Perhaps the 50-period moving average. But again, even though we've got higher lows in here, right? We clearly have higher lows, but we have not yet made higher highs. And so this becomes an important spot for us once more. Okay, and that's around 64 to 64.5. So just give some thought for that. All right, so I wanted to make sure we hit on all of those for everyone today. We do have a little bit more of a push, which we like to see. So, the Russell up now 1.5, the semis 4%. Let's go back to the semis real quick, and we'll go back to that hourly, and then let's put up back the 20-day. And let's just, okay, so here, yeah, we're moving okay. but obviously we want to see some real continuation. But this is already beginning to be a little bit more comfortable for us in the early going here today. All right, let me just hit on some of these chat details, just see if there's anything else that I wanted to touch on briefly here. If I don't touch on something, please know that that's not that I don't appreciate it, just trying to make sure I get to as much for all of you as I possibly can here today. All right, let us take a look at our sector moves here today. So let's go back to our Market Watch tab. Let's go to the quotes page and let us see our leadership. So the last week and a half, 2 weeks, 3 weeks even, I have been looking in our defensive groups, basically leaning into healthcare, financials, and staples. As of yesterday, for the 5-day window, we had healthcare and staples both up more than 3%. So clearly healthcare pulling back a little bit from that, or it has not been as strong over the last day. But staples is holding up. Let's look at a couple of those defensives and let's see if this is an area where we need to be maybe giving some thought. So we'll start with our not discretionary staples. So staples moved really well off the 200-day there. And now that we're getting a little bit more back into tech, you're seeing staples take that breather. That should not be a shock, right? As we talk about the relationship here, everybody, it is so important, even on a short-term basis, to know where does money go when we start selling tech? What do we want to look into? What could be the working area? And it could have been staples for the better part of the last week here. There have been some good moves. Same can be said with healthcare. And healthcare is at resistance to an extent, but it's also holding and building out a bull flag. So some of you traders will note that we've got this gap zone here that's basically the flag. You can basically draw that in and pop that up there. And you might say, hey, if you were trading this, if you had a single security that was traded like this and you bought it around the 50-day moving average and it rallied like so, some traders would take a little bit off if you closed below the low of the flag here, and they would take a little off from a defensive standpoint, take some profits, pat themselves on the back. And of course, if it went to the upside, broke out there, they would certainly stick with what they've got, but might then put an exit strategy below that breakout spot, thinking that, hey, if it's a legitimate breakout, we should not get thrown back to beneath that, back into the flag portion, right? So we're looking for continuation. Continuation will occur with a new high, short-term high, that is, and that's what we're hopefully looking to see here in healthcare. Now, if you were that trader who wanted to expose money to the beaten down groups, communications is approaching its 200-day moving average. This becomes an interesting spot. Of course, the 200-day for you long rangers, your long-term investors who look to deploy money over the long-term thought process and are less concerned with the trend, a very common approach is just to find the 200-day moving averages and use the test of the 200-day as a way of adding and exposing money. So maybe giving that one a little bit more wiggle room here, but the communication space is encroaching on it. Tech is rallying nicely back so far, but I have to point out on the daily chart, everyone, we have not done anything to the trend just yet. We like the move. Everything happens a little bit at a time, right? Baby steps. That's why we look at the hourly. But we have not traded to a level that will tell us that everything is fine and we're back on trend. Unfortunately, as it relates to the daily chart, that's going to be up here at the 20-day moving average. And so that's the thing. This is where we get to be a little sticky. For a lot of traders, you'll get a good day today potentially. Maybe the day finishes bullish in tech. We get a 2%, even a 3% rally. And then we're up there near the 20-day again, but then we can't get through it. And if we run into the 20-day moving average and can't get through it and the sellers come back to the table, well, then that is not going to present favorably on a daily chart. It's going to look like another 20-day rejection, and the potential then exists to revisit the lows we've already made in the last 3 days, potentially make a lower low. This is the risk factor that we have to keep paying attention to, and it's exactly why, for those of you who feel compelled to look at this stuff on a shorter term basis, it's why I think it's so important to work with a time frame beyond the daily. Make sure you're drilling into 5-minute bars or 15-minute bars or even the hourly. Or maybe you just need fewer data points and you want to go with something like the last 6 months and you need 4-hour bars. I mean, this is basically the same as what you're seeing in the daily, but it's just a little bit more clear, isn't it? I mean, it's pretty obvious where support resides now in this particular sector. And if we break through the 64.38, 64.40 with any conviction to the downside, we've got a pretty decent sell on to the support line that I just drew in. So, hopefully what we're talking about is just reiterating things that you've already learned, and all I'm doing is just throwing a little bit of light on those ideas. So have we broken things yet to the upside? Not so much. We like a little bit of improvement, but in order for us to feel a whole lot better, we need this candle to hold, don't we? Because, right now we're trading above the high of our last candle, which could lead us to making a move to that last high. Okay, and if nothing else, that becomes a potential short-run target for us. Would be cool to see that, better to see us up here, right? But even up here, if we're not back above that 20-hour moving or 20-period 4-hour block moving average, well, then what are we working with, right? Because we know that it was support for so long, right? Remember, what was support can become resistance. And so now we should be looking at the 20-period moving average on this chart as resistance until we can trade above it. All right? All right, let's take a look at what else is happening, but this is in the way of individuals. So let me take a peek here at my monitor portfolio in the other. Okay, we do still have our Synopsys trade on. So let's briefly talk about this before looking at stocks in the news. So I'm going to actually apply my orders and trades on this. So we got in here at 489.34, basically bought on the test of the support line in here. And then we used the 200-day moving average and the average true range as a mathematical calculation to set our exit strategy, our current stop order. Now, because the stock, since we've owned it, has not moved into that resistance, nor has it made a new high, there's absolutely no reason for us to make an adjustment to our exit strategy. This order to sell our shares at 442.87 does not guarantee a price for us. It just says if that level is achieved, it will trigger a market sell order. So we have risk that we gap below our trigger and then we get sold out at a much lower price. But we built the trade based on our entrance and our comfort for loss in the trade. And I want to encourage, one thing I can encourage you all to give thought to is building your trade from the side of what if I'm wrong? Always being thoughtful of where will I move on if I am proven wrong by price action, and what will that amount to in the way of a loss, and making sure that that approximation of loss is in your comfort zone. Remember, traders take losses. That's part of our process. But the key to taking losses is to try and limit them to comfortable percentages so that we are willing to move on when they get hit. We do not want to stick with losers longer than we should. We want to stick with winners for as long as possibly can. So no changes on this order at this point. Synopsys will stay. We'll give it another week. Maybe we'll take a look at this next week and see if we get any opportunities here. Okay, let us talk about some stocks in the news. Let me find my review here. We had some upgrades and some downgrades to take a look at. Some interesting upgrades. One of those is in the tech space. So we got an upgrade on Intel. which is nice to see. Bank of America upgrading Intel to buy from underperform. New target is at 135. That's up from 96. Bank of America cites higher confidence in Intel's opportunity to address industry constraints in leading edge wafers and packaging, as well as their supply into a much larger agentic CPU market. So this is a positive. Now, obviously, that 135 target represents a nice little premium. No guarantee we get to that. But the pattern that we're seeing here developing is kind of interesting. Let's look at this on a weekly, and I think it'll appear to be quite a bit more obvious. Yeah, it's clearly a bit of a bull flag. So you've got lows recently established in here. Take this line, activate, and add it up here. And we are possibly breaking it, but we're still in the flag. This is a lovely and strong, massive bull flag pull, huh? 6 weeks. It made 225% move and is building on a flagpole. Now, why is that significant? Well, the potential exists. Again, it's a measured move and it's no guarantee that it's achieved. But one way to look at this would be to just draw that line right and take the height of the pole and add it on. That's option one that some traders would look at. You could also draw that line from the breakout of the flag, like so. So you could draw it from the bottom of the flag or the top. Waiting for the breakout is key here. Another consideration could be, real quick, to use the height of the flag and give you a target. And that could be, if it breaks out from the flag there, maybe you get a 20 to 25 point pop to the first extension at 161.8. So that could certainly be the case, but you got to wait for a break. Remember, if you're trading a flag, the thought is you stick with it until it breaks one way or the other. Currently, we've not had any breakdown, so you don't have that playing out, but you've also not broken the downtrend line yet. In fact, today's high rallied into it, but has not broken. So you're looking for a close over that downtrend line as potential validation of continuation of trend. So nice little upgrade there on Intel. Jefferies upgraded a defense company, General Dynamics. Let's take a look here. Now, boy, this one was was in a bit of a slog there into late April, huh? And then earnings hit and you got a nice pop right back into the range. Now, most recently, let's see here, maybe draw some resistance in this vicinity. And if we took out, kind of look at it like this, then the action you're getting today looks bullish, right? The note here is from Jefferies upgrading General Dynamics to buy from hold with a new target at 400. That's up from 380. The company's marine segment, which represents 33% of their sales, has grown double digits in 11 of the last 13 quarters, according to Jefferies analysts. So that's interesting note, and I certainly think it's an interesting development when you break that downtrend line. A lot of traders look for downtrend line breaks like this to get started in new positions. And I say get started because, again, I want to remind you that not all traders trade all in or all out, right? They often will trade, okay, I got the break of one level, let's add 25% of what I normally would, and let's see what happens from here. If we can get the continuation and it rallies up to 370, then we've got some decisions to make. Or maybe you stick with it, and then it takes out 370 to the upside, and then the trader says, well, I'm going to use that as a reason to add, and that can work as well. So assuming you're comfortable by being a buyer on breakouts. Not everybody is, but I think if you've participated in this market, not this particular market, but in the market long enough, you recognize that stocks making new highs. That's not a bearish indication in any way. Okay, what about, you know what? One more upgrade here is in CME. All right, CME Group. Got an upgrade today at Rothschild, and Redburn upgraded to buy from neutral. Target here at 323. That's a really nice premium relative to where we are. This stock has been in a downtrend. I'm always hammering the analysts for giving us late notification on changes like this, but if nothing else, this stock just made a new 52-week low 2 weeks ago, and you're getting an upgrade. So granted, I don't follow CME Group specifically, excuse me. But I am at least interested in the fact that the analysts are telling us something in a downtrend, right? The stock has clearly struggled, so they have done some research that leads them to think that there is some upside. And if that, looking at even their old number, 316 was the old target. Now it's 323. 323 would be basically close to the prior 52-week highs. That would be an excellent development. Now, first thing we got to do is make sure that we get back into trend. Having made a lower low, the lowest low we've seen in the last 52 weeks. The 20-day could act as some resistance above us. There's a bit of an important level here. Prior gaps, right? So maybe we can get through 274, 275. That would be significant potentially on CME. All right, let me, I think I'm going to have to wrap it up there, everybody. We are just about at time. So I'll remind you all that we have that survey opportunity. Thanks once more, Scott, for getting that into the chat. Really appreciate your comments and your feedback, everybody. I would love to hear from you. Make sure that you're following us on X, Kevin Horner, CS, Scott Thompson, CS. I'm also there available on LinkedIn. I'm working hard to get my posts onto LinkedIn as frequently as I post on X, but a little bit of a challenge for me to get it all done frequently enough. Hopefully we can I can improve that for all of you. And make sure you're subscribed to the channel, of course. Subscription levels help us as a team quite a bit, and the thumbs up down below will help us in the replay of this particular segment, as we will get it archived shortly here after the completion of class. So with that, again, thanks, Scott. Thanks to all of you. I'll just try to keep bringing back the Thinkorswim Starburst shirt periodically. I sure enjoy wearing it. I hope you all have a fantastic rest of your Thursday. More to come from us here all day on the channel, so you can keep it tuned to Trader Talk. So have a great Thursday, everybody. I'll see you again real soon.